What's up, y'all? I hope y'all having a good start to your week already. I know it's early. Well, it is early Monday morning. Um, so we're gonna get right into the next series or the next part in a series of advanced fundamental concepts. And last week we left off discussing solvency for any particular publicly traded company where we dove a little bit into the short-term debt that companies hold. And remember, short-term generally refers to debt that's due within the next 12 months or so. So we're going to continue that conversation, except we're going to do a little investigation on the long-term side of things with the interest coverage ratio and the debt to equity ratio. So the interest the sorry, the interest coverage ratio basically measures how many times or basically measures the company's ability to cover its debt payments with money coming in. So is this revenue sufficient to cover is this revenue sufficient to cover the interest payments that are due on a regular basis? So one way to calculate this formula is to take the earnings before interest and taxes and divide it by the interest expense. But what a good way to modify it because so the EBIT. A good way to modify it because are taxes is something that the company has to pay, and it's kind of it's separate. It's a separate payment from the interest expense. You may want to do earnings before. Um, Hold on a second. The earnings after taxes. So excuse me. So yeah, so you take the hold on, let me make sure I'm correct on this. Yeah, so earnings before interest and after taxes. So EBIAT instead of the EBIT, which is the general formula. So earnings before interest and after taxes. So in this sense, you take taxes out of the equation. So you take your EBIT and you subtract whatever tax payment the company has to pay, and then you divide that number by the interest expense, and then that gives you a ratio, and that's your interest coverage ratio. So investigating that number, for one, you have to consider the industry that company is in. Generally, as per my research, generally an interest coverage ratio of 1.5 is like the bare minimum that is considered quote unquote acceptable. So you can't apply that, however, to every single industry because the interest coverage ratio will vary across industry. So it's one of those numbers that, for one, you want to compare over time uh, from one year to the next for a company and see how it's trending. And two, you want to compare it to its competitors to see if, it's an outlier, to see kind of what the general industry range is for that particular industry, and then compare where the particular company that you're investigating, compare where that falls within its industry. Um, an industry like, utilities or energy, they're generally going to have a low uh, interest coverage ratio, and it's acceptable for that industry. Um, because we know, a lot of companies in that industry, they're financed by, they're heavy on the debt side, I should say. So just because, Duke Energy may have and I'm just throwing a number out there, I'm not sure what their interest coverage ratio is. Just because Duke Energy has an interest coverage ratio of, 1.5, while that may be low, that's acceptable in that industry. And the industry average interest coverage ratio may be, 2, you know. So you can't just look at one company and not consider it within the context of the overall industry and its competitors. Um, so that's pretty much it on the interest coverage ratio. It allows you to investigate if that company can make its debt payments that are due. So while the current ratio investigates the short term um, debt, so its current liabilities, the interest coverage ratio um, lets you know whether the company has sufficient monies coming in on a regular basis that can cover its bills, or not its bills, but its debt. Moving on to the debt to equity ratio. This one is about leverage. So generally, a debt to equity ratio over 1 and higher is telling you that a company is financed pretty much mostly by debt. Um, the debt to equity ratio is pretty simple calculation. You subtract, not subtract, but you divide a company's debt by its shareholder equity. So we all know with the balance sheet, assets equals liabilities plus shareholder equity. So you take that shareholder equity piece and divide it by, or divide it into debt. However, since we already have a ratio that investigates the short term or the current assets, you want to kind of modify the debt to equity ratio by taking out those current assets. So basically, not current assets, I'm sorry, current liabilities. So and I think I said current assets for the quick ratio, the current ratio, but I meant current liabilities. So with the debt to equity ratio, you take the liabilities, total liabilities, and the general formula is total liabilities divided by shareholder equity. So you take the total liabilities and you subtract those current liabilities, and that'll give you your long-term liability. So anything due outside of a year, generally speaking. And then you divide that by the shareholder equity. And so that gives you an idea of, okay, uh, how is this company um, financed mostly by debt or by equity? So a debt to equity ratio less than 1 lets you know that the company is mostly financed by shareholder equity, and it's not a very leveraged company. So on the flip side, a company, the higher over 1 that debt to equity ratio is, then that lets you know that the company is financed mostly by debt. And this is Apple. As you can see, its debt to equity ratio is 1.56. So a lot of its operations are funded by debt. But a debt to equity ratio of 1.6 isn't concerning at all, especially with Apple, when we know Apple has strong cash flow. You see its interest coverage is 23.41. Um, there's no solvency issue with Apple, and we know that Apple has billions, hundreds of billions of dollars in cash. So, um, of course, the higher, lenders would look at that debt to equity ratio, and the higher that number, uh, the more risky it is to shareholders. Um, so, and yeah, I said shareholders, so investors. Um, what else can I say about those two? Don't get caught up in thinking, oh, this debt to equity ratio is bad because it's high. You have to consider the industry, you have to consider the company, and think about, you know, if this company has a high debt to equity ratio, it's also saying to you that this company is being aggressive in its financing of its growth with debt. So that's just another kind of perspective on it. And again, another thing that you want to um, investigate and compare across across companies of the same industry. Um, let me see, what else can I say? Probably most important with the debt to equity ratio is to remember to take out those current liabilities, because there's no, current liabilities have a different impact on the company's cash flow than does the long term stuff. So you tend to want to try to keep those things separate when evaluating the financial health of the company. Kind of treat them as two separate um, entities or situations. So I think that's all I have on those two. So interest coverage ratio and debt to equity ratio, and in all the four ratios that I discussed over the past 2 weeks, kind of give you a good picture of the financial health of a company, the solvency of a company, um, and not just that, but also liquidity. So if you have any questions, any comments, any feedback, I welcome it, and I thank you for watching. And I hope this was very useful for you. Have a good day.